In my mind, it's very clear it's not the start of a bear market. I mean, the market is very concerned about earnings because of rising interest rates. And I think interest rates are rising for good reasons, and that's because the economy is strong. And everybody was waiting to see what the company managements would say. Earnings have come in probably 80% beating expectations, but what's been interesting to me is revenues. 2/3 of companies are beating expectations in revenues. And that's not something that's going to drop off quickly.
I mean, you're not seeing the reactions in the stocks.
No, that's because we've started with this correction. You've got such fear and uncertainty, any worries about the trade, the Fed. But I think these are short term. But I think the market will stabilize. Somewhere in here, there's a bottom. I don't know where, but I think it's going to happen after midterms. Although I don't think midterms has been a factor in the correction. I think it will be a factor now over the next 10 days, waiting until things stabilize. So no, I think earnings ultimately will out, and they're not, in my view, not about to drop off a cliff.
Sam Stovall, do you agree with that this is just a correction inside of a still stronger market, or the start of something more worrisome?
Hey, Brian. Well, I do think that we're headed for a correction. I think we do end up going deeper, that we did not see the flush out yesterday, as Michael had mentioned earlier. Basically, 70% of the time, whenever we have had two such declines of 5+% in a single year, the second one has been deeper than the first. And my estimation is more on technicals to say that I think we probably have to test the 2580 to 2600 zone, which would represent about a 12 to 14% decline, which would satisfy, in my opinion, the need to reset the dials.
So one question is what stops the bleeding here? I mean, we are seeing a bounce today. Let's see if it holds up 300 points. Rick Santelli, do you buy the argument that Fed Chair Jay Powell needs to respond to what's happening in the market and what we're getting from earnings and some of the concerns out there in order for this market to calm down?
No, absolutely not. Everybody likes to whine about the messenger. Listen, whether it's Mr. Powell or somebody else, somebody had to get the broom to sweep up after the central bank parade. The lights went on, the room's messy, the street's messy if it's a parade. They need to do something. We should thank God that we have a central bank that is trying to find some normal activity and trying to set the stage for a more normalized policy in the future. Other central banks aren't doing the right thing. Yes, everyone does like to whine. Investors want immediate gratification all the time. Listen, a correction? Absolutely. There is nothing wrong with the real economy. Nothing wrong with it at all. But that doesn't mean there isn't a logistical pileup on the financial assets that make up the capital markets. And I think that's what we're going through. Listen, we've had some pretty decent policies in this administration that are good for the economy. It's evident by 18-year high in confidence today. We've seen other data points. Not all of them are on their highs. But in the end, we've seen a lot of piling in over the last 5 or 6 years in the equity markets. And I think that they're going to have to get their legs back and recalibrate with the real economy. But I don't think this is the dire move by any stretch.